Chevron is trading at a PE of only 14.7, which is a massive 45% discount compared to the S&P 500. But oil companies are cyclical, and we may be at the top of this earnings cycle. Today's video will be an in-depth analysis of Chevron stock, covering business operations, fundamental, and technical analysis. Chevron generates net income primarily from their upstream business segment, which encompasses the exploration and production of crude oil and natural gas, accounting for 74% of their total net income as of their 2023 annual report. Their other business segment, titled Downstream, focuses on refining, distributing, manufacturing, and retailing crude oil and natural gas, making up 26% of their net income. I'd really like to know their net income by product type, like how much income they earn from oil as compared to natural gas, but I couldn't decipher this data to determine that. But I suspect it's crude oil based on how correlated their earnings are to oil's price per barrel, which we'll get into later. In terms of production of crude oil, they have slightly reduced their output over the past 3 years, while they've grown their natural gas liquids production and remained flat in terms of natural gas production. Their net proved reserves have declined slightly, but this number fluctuates normally as they are always searching for and acquiring new reserves. By geography, Chevron is predominantly an international business, with 66% of net income coming from countries outside of the US, leaving 34% of net income from the United States. Although in terms of production of their commodities, they are more concentrated in just 2 countries, the US and Australia. Most of their crude oil comes from the United States, while most of their natural gas is derived from Australia. To put their business simply, though, they extract natural resources and sell them. Now let's cover the macro-level pros of Chevron's business. Chevron produces some of the world's most essential commodities, which are crude oil and natural gas. You've probably noticed the shift of modern vehicles switching from internal combustion engines to electric powertrains. But according to research by McKinsey, as of 2019, only 2.5% of global light vehicle sales were electric, meaning that the vast majority, or 97.5% of 2019 sales, are still running on oil. Better yet for Chevron, this data looks at recent car sales, while most of the cars on the road today have been produced over the last few decades and will continue to require oil to keep running into the future. Or if we were to look at electric car demand increasing from another point, we could look at how those cars would be charged from the grid. Most of the world's grid energy comes from coal at roughly 36% as of 2023, but the next largest contributor of energy to the grid is natural gas, which again is a commodity produced by Chevron. But we'll come back to the grid and electric cars in the risks portion of this analysis. Yet another driver for demand of oil is plastics, which have continued to increase in usage over the decades, and their usage doesn't look to be slowing, at least not globally. That's probably because it is used in so many different items like electronics, cars, bags, and fabrics. On a side note, polyester is an oil product and a popular clothing fabric, and if you're wearing it or sleeping in it, it's likely the cause of sweat and smell, since you're basically wearing a plastic bag. Although plastic usage is up globally, only 6% of the total usage of crude oil goes to plastic production, so it likely only represents a minor portion of Chevron's earnings. All of the different uses for oil and its growing demand can be seen by the total production of crude oil over time, which has grown by 25% since 2005 to today. The other primary product that Chevron produces is natural gas, which is also increasing in demand over time by a rate of 29% since 1989. The final pro that I see in Chevron's business is that the demand for their products is global and well diversified, and the world still runs on fossil fuels. Chevron seems to have a few tailwinds to its business, but there are some major risks to consider. One of them being that Chevron doesn't determine the price or value of the products it produces. The price of crude oil and natural gas are determined by the market. When these commodities are valued highly, they earn more income, but inversely, when the price declines, so does their earnings. And the price of oil is volatile, which we can see here through this chart of Brent Crude over 25 years, which reached a high of $140 per barrel in 2008 and a low of just $23 per barrel in 2020. This volatility is directly correlated to their earnings, which we can see when we compare both the price of Brent Crude and their earnings side by side over 10 years. I don't know about you, but one of the main attributes I look for in companies is earnings stability. Yet another con for oil companies is that vehicles are becoming more fuel efficient over time, which is shown through this graph in terms of vehicle fuel usage globally since 2009, which translates to decreased demand for oil. Not to mention that the electrification of cars is growing rapidly and is likely going to continue to grow over time, which will also in turn decrease demand for oil. But what powers electric cars and the grid? Well, it's predominantly coal and secondarily natural gas, a product which Chevron produces. But natural gas makes up only 22% of the total global grid, and green alternatives like wind and solar are growing rapidly, especially over the last decade. Which leads me to another topic, which is environmental policy. Around the globe, and especially in more developed nations, countries are attempting to curb CO2 emissions by replacing fossil fuels with green alternatives, which can lead to the gradual decline of oil and natural gas demand. Although it looks like these policies globally have been ineffective in causing any drastic change in total CO2 output, which we can see through this graph of CO2 emissions since 1895. Yet another con for the oil industry is that there's nothing proprietary about the commodities they produce. Oil is extracted and refined around the globe by many different companies and nations, but the end product is more or less indistinguishable between those parties. Or in other words, there's no secret sauce that differentiates Chevron's oil from any other oil or natural gas producer. Chevron faces major competition in the oil extraction and refining industry, like with Saudi Aramco, which is currently the 5th largest publicly traded company by market cap, and roughly 7 times the size of Chevron in terms of market cap. Otherwise, Chevron competes against whole nations that operate state-owned oil companies like these, who can take losses in order to undercut other big corporations, since they can make decisions that aren't necessarily aligned with profits, but rather national interests. Now let's get into the foundation of Chevron's business, starting with revenue. First off, their revenue is quite inconsistent, and over an entire decade has only grown by a compound annual growth rate of 0.16%, going from $192 billion in 2014 to $195 billion as of their trailing 12 months, which are some huge numbers but with almost no growth. Although, if we were to look at just the last 5 years, the CAGR is substantially better at 7%. But how does this translate into net income? Well, the story is basically the same, with drastic inconsistency in net income, but with a higher 10-year CAGR of 2.6%. Or if we look at free cash flow, we see they had 3 years of negative free cash flow from 2014 to 2016. And if we flip back to the 10-year price chart of Brent Crude, we can see earnings and free cash flow are directly correlated with price per barrel, and who knows in which direction it will move next. Now we see shares outstanding, which is especially important for a company who pays out a lot of their cash as dividends, which is because a dividend aristocrat like Chevron is basically indebted by their dividend streak, and if they were to reduce their share count, the total amount of dividends distributed could be lowered too, while still receiving the same dividend amount per share from a shareholder perspective. In Chevron's case, they have only minimally reduced their share count over the decade by a CAGR of 0.1%. Now we see their total liabilities over the decade, which have surprisingly declined from $110 billion in 2014 to $100 billion as of their last report. Although their cash on hand is also declining, which was at $13 billion in 2014 and now sits at just $4 billion as of their latest report. So it looks like they've simply used their cash to pay down their debt, as the difference between the two metrics is $9 billion. More importantly though, I like to compare liabilities to net income after accounting for cash. So if you take their total liabilities of $100 billion and add back their $4 billion in cash, they have a true liability level of $96.4 billion, which is 5.1 times their trailing 12 months net income of $18.7 billion, which is quite modest and shows that despite their cyclical earnings, they've been able to manage their balance sheet quite well, at least for now. If you want to use the same platform for your analysis, Seeking Alpha, you can use my link to get $25 off an annual membership, and I'd be forever grateful for your support. Now that we've covered the foundation of Chevron's business, we can get to the reason why you might be considering investing in them, which is their dividend. They offer a current dividend yield of 4.3%, which is 1.5% lower than their average dividend yield over the last 5 years, not indicating a particularly advantageous buying point. Nor is the yield particularly high from a 10-year perspective either, although they've grown their dividend consecutively for the past 36 years, making them a dividend aristocrat. And better yet, they've had an uninterrupted dividend streak without a reduction for 112 years. But what do you guys think? Will this dividend streak hold up for another 100 years? Let me know your thoughts on the future of oil in the comments below. In terms of dividend growth, they've been fairly consistent with a 10-year dividend CAGR of 4.5%, a 5-year CAGR of 6.4%, and a trailing 12 months growth rate of 7.2%. But how safe are these growth rates based on the earnings or free cash flow payout ratio? Over the last 10 years, and including the TTM payout ratio, their average payout ratio as a function of earnings was 84%, which I calculated by adding up the years of dividends per share and dividing by the earnings per share. While their free cash flow payout ratio is even higher, coming in at 90% of free cash flow distributed as a dividend. So depending on what happens with the price of oil, their dividend may or may not be safe. In terms of valuation, they are trading at a TTM PE of 14.7, which is objectively low compared to the S&P 500. But Chevron's earnings are inconsistent and sometimes negative, so this doesn't give a true sense of value. And because the earnings have been negative within the past 5 years, their 5-year average PE ratio isn't shown. So I think determining value for Chevron makes more sense by using the current dividend yield compared to the historic dividend yield. Or we could compare Chevron to the energy sector ETF XLE, which has 91% of its holdings in oil and gas, and is trading at a forward PE ratio of 13.5, which is 13% higher than Chevron's forward PE ratio of 11.9, indicating some value for Chevron. I'm not sure how many of you have watched PPC Ian's YouTube channel, but he offered some great advice once, which is to buy oil companies when their PE ratios are negative. If you were to do that during Chevron's latest negative earnings cycle in 2020, you could have had a starting dividend yield of almost 9% and a current dividend yield on cost of about 12%. In general, with cyclical industries, it's usually best to invest when outlooks are grim and earnings are low, in anticipation of the cyclical rebound. Here we see a 5-year price chart for Chevron, and we have a few key aspects of this chart to interpret, starting with the 5-year price trend, which is moving up and to the right, and over this period, Chevron has had a modest price return of 25.7%. In terms of the standard deviation channel, Chevron is undervalued as it is below this center yellow channel line, which is the average price for this period, making the current price of $147.95 15% below the average of $174.26. In terms of support and resistance, the price looks to have respected this support level of about $140, although it doesn't seem to have much momentum behind it, and may fail to continue upward in the near term. This lack of momentum can be seen through the RSI graphed at the bottom of the chart, which looks to have stalled out. Although objectively, the RSI still indicates value as it is near the bottom of the channel, at its current level of 42.6. So technically, from a 5-year perspective, Chevron looks to be at a slightly opportunistic buying point. But since Chevron is a well-established cyclical company, I think it makes sense to look at the 10-year chart where the current price is right at the center standard deviation channel line, or average price. Or if we wanted to look at the energy sector more holistically, through the ETF XLE over 10 years, we can see that the sector as a whole is overvalued, being far from the center standard deviation channel line, overbought according to the RSI, and is actually near an all-time high of $101. Or in other words, we look to be near the top of this cycle. Thank you guys for watching, and if you found value in this video, please do all the things you're always being asked to do by other YouTubers. And if you're interested in high and consistent dividend yields, you may want to check out this video covering the Bank of Montreal.
I'm not a financial advisor, and this is not financial advice. This is for educational and entertainment purposes.